Comps versus DCF. Defend your valuation to an IC with confidence. Welcome. In this micro lesson, you'll learn how to confidently defend your valuation to sharp investors and tough investment committees. Your job isn't just to present a number, it's to explain why that number is credible, how your method matches the business model and available data, and how your logic anticipates pushback. We'll show you when to use comps versus DCF, how to choose an anchor method, and the language that signals rigor. By the end, you'll be ready to preempt IC questions, justify assumptions plainly, and close with a clear, defensible valuation range and recommendation. Use comparable company analysis when you want a market-grounded view of value today. It reflects near-term reality, what similar firms actually trade at, so it's ideal when public comps exist and the sector is active. Comps anchor expectations to observable prices and investor sentiment, not theory. They're fast, transparent, and easy to sanity check with a few clean multiples like EV/revenue, EV/EBITDA, or PE. If your company's model, margins, and growth resemble a known peer set, comps help you frame valuation in language the market is already pricing every day. Choose a DCF when you have reasonable visibility into cash flow drivers. Pricing, conversion, churn, unit economics, and reinvestment. A DCF values the long-term economics, not short-term hype or momentum, making it powerful for businesses with durable moats, contracts, or stable cohorts. The catch: it's sensitive to assumptions. Growth rates, margins, reinvestment, WACC, and terminal value can swing outcomes. That's fine. Just justify each input with evidence: cohorts, funnel metrics, cost curves, or contracts. A well-supported DCF shows you understand how the business actually makes and keeps cash. Lead with the method that best fits the company's risk profile and data quality. If the market is liquid and peers are tight matches, anchor on comps. If you have clear visibility into drivers and durability, anchor on DCF. Then use the other method as a cross-check band to test reasonableness. State this early: we anchor on DCF given contract visibility. Comps corroborate within a 10 to 15% band, or the reverse for market-driven cases. Declaring the anchor and the corroboration up front guides the committee's expectations and frames every discussion point. Use clear causal phrasing that shows structured thinking. For example, given X, we prioritize Y because ties evidence to method choice. On a like-for-like basis, comps imply tells the room you normalize differences before comparing. Our DCF triangulates to a range of, signals cross-method validation, not a single-point guess. Sprinkle specifics. Given 85% gross margin stability, we prioritize DCF because cash conversion is predictable. This kind of language helps you preempt pushback, demonstrate discipline, and keep the discussion on facts, not opinions. Start by defining true comparability: business model, margin profile, growth rate, and capital intensity. Explain why each peer qualifies and why others don't. Then normalize. Adjust for scale, operating leverage, accounting differences, stock comp, capitalization, and one-offs, COVID bumps, asset sales. Finally, unpack multiples. Discuss the level, e.g., 8x EV, EBITDA, the drivers, growth, margin durability, net retention, and the dispersion across peers. On a like-for-like basis, our peer set trades 7 to 9x due to higher NRR and lower churn. We sit mid-band, given similar margins, but slightly lower growth. Open the model, show unit economics and a simple driver tree: price, right-pointing arrow conversion, right-pointing arrow cohorts, right-pointing arrow churn, right-pointing arrow contribution margin, right-pointing arrow reinvestment, right-pointing arrow free cash flow. Then pressure test the big levers: WACC, near-term growth, margin expansion, and terminal value method, perpetuity versus exit multiple, with clear justifications. Run scenarios, base, upside, downside, and show valuation elasticity. A 1% WACC increase reduces value by 10%. Terminal growth, plus or minus 0.5% shifts by 8%. This transparency turns sensitivity from a weakness into a demonstration of control. Finish with a crisp, evidence-backed range. State the weightings and rationale. We anchor on DCF at 60% due to contract visibility. Comps at 40% to reflect market reality. Present the numeric band and what would move it. Key sensitivities are churn, CAC payback, and WACC. We'll monitor cohort retention monthly and financing conditions quarterly. End with a recommendation. Proceed at the midpoint with a structure that flexes based on retention thresholds. This leaves the committee with clarity, contingencies, and confidence in your process.